Hi guys, welcome to Investing with JYK, and today we'll talk about a BDC, a business development company called OHA Investment Corp. So I actually got into this quite a while ago, somewhere around um, March, I think March before the dip, the March 10th or something. Back then, this company was having about a 13% dividend and a 0.4 PB. And I thought that was really cheap. And I thought it was really cheap based on my experience on PSEC, Prospect Capital. And in that company, I was able, whenever I bought, at around 0.6 PB, I was able to make a fairly decent gain. I think I did that twice. But for this one, I bought in and immediately it dropped to 130 something. I think I sold somewhere here after realizing that I have made a mistake. This company is not comparable to Prospect Capital. So what was the problem? This company had a huge oil exposure, so they lent a lot of money to these guys. And these guys got to see this coal mining, oil, natural gas production, oil, natural gas, oil, natural gas, oil, natural gas, oil, natural gas. You get the picture. You got oil, natural gas, just all these. And what happened in 2015 was oil price went crazy down, and you can see that actually followed. The company stock went from $4 down to about two, and then even after oil price went up, the company that they lent to no longer had the capability, had the capacity to pay back the loans. So most of these loans defaulted. And this is something that um, I overlooked and did not spend enough time understanding. I did not spend enough time understanding their investments. Um, so their asset basically wasn't as they appear. Obviously, there's always a problem of investing in BDCs because these are not publicly traded securities, so there's not enough information uh, um, in this to understand exactly what these companies are capable of. But um, some of these are commodity producers. You can see the coal and oil and natural gas and all these guys. You can understand to the extent that you kind of know the commodity cycle. If the price of coal declines, the coal companies can't do very well, and these are fairly high interest rate loans. Okay, 12%, and then 6%, and you also got some equity in here. Right, so um, they had a huge exposure, and so you can see the fair value of the coal was down to less than half. And same goes, well, for this particular spirit resources, it's even more ridiculous. It was something like, you know, this is a complete loss. Tranche B is complete loss, and then the preferred units, essentially preferred equity, is complete loss. So they are the focal. I think it's called the fulcrum capital class is already at the tranche A, and tranche A is and this is a senior secured term loan. So this is as high as you can go. So this is the tranche A of the senior secured term loan. So this is as high as you can go in a capital structure. If you think about it, your senior secured loan sits above the senior unsecured loan, and then according to this, uh, they're breaking it up into tranches. The first tranche will be made full as long as any of the tranche B gets paid. So if tranche B has even 1 cent getting paid, tranche A is going to be made full. But in this case, tranche A, even tranche A is almost a total loss. So it's pretty bad. And so so this is March 2030, March 2015. So when I invested, it was somewhere around here, and you can see that you've got some kind of loss here because the subordinated note, the cost was higher than the fair value, so they're estimating some kind of loss. So this is already fishy. And this guy, the second one, the Class A unit, essentially, this is equity holding, and then there's quite a bit of loss. So this is the same company, the OCI Holdings, and the equity is almost a complete loss, and then your subordinated loan, there's some loss that's been estimated. So it's a fishy company, and here the equity is like 80% loss. The software seems to be doing just fine. Then this information service seems to be just fine. And then this guy, again, this is senior unsecured notes. There's significant loss compared to cost. And this is leisure goods. It seems Equinox Holdings seems reasonable enough. I'm not sure if this Equinox is actually the other Equinox. The pretty expensive gym, but floating rate loan, and there's no estimated loss, so seems okay. They are getting some paid, and this thing seems to be fine too, and this aerospace seems to be fine too, and then the chemical seems to be fine too, and these all seems to be performing loans, and then this one is a loss. The financial services is basically they bought some distressed loan. If you look at it, the principal is 9,000. They got 1,000. They paid 1,000 for. Well, this is probably in 10,000s and in thousands. Yeah, so they paid $1 million for $9,000 of face value and then estimated some kind of stuff. So they think they have a gain, but these are all illiquid instruments. So I won't put too much emphasis on this, but essentially they're doing some distressed investing. And then if you go down here, this seems okay. That's a total loss. You got ATP is a total loss, and then you got a Shoreline Energy, a total loss. So yeah, and then so that was a pretty bad loss. And then if you take another quarter on, they actually they took even more loss. So you can see the equity for OCI is now a total loss, and the Castex lost even more. Talos lost even more, and then again see this guy. Oh, they're getting paid. This is actually they're doing pretty well. Well, that was finally a good investment. Well, again, this is a total loss, right? So this one is probably, when I read this, what I should have picked up was that this OCI thing is in danger. The equity is now well, it's actually not a complete loss. It's very close to a complete loss. By the time this goes away, the next thing is going to be a subordinated note. That's coming next. Basically, this is the next one to suffer, unless they have some kind of preferred equity. I don't think they do. I have no way to check though, so I'm just guessing. This thing is in danger, obviously. This thing is in danger, and so there's, how much is that? You can actually compare this to their equity, right? In terms of equity size. So this is $14 million, about $15 million at risk. And then this guy, I don't know how much they may lose. Maybe they have a buffer of 300, so maybe potentially $1 million, $2 million. So you're looking at, let's say $5 million, so $20 million total loss there. And it's actually pretty bad because their book value, their total equity, let's see where the equity is. Can't find it. Let's see. Net asset, yeah. You're looking at this line here, 55. 55. So if you subtract 20, you will be looking at 35,700, right? And guess how much the market cap is? It's 29. So you actually get still a little discount. So I'm thinking at this current price, at the amount of deterioration, this might be a reasonable investment. But let's look at the newest. So this is the newest report. They don't have the quarter Q1 yet. Here we go. You see there's even more loss in the subordinate note. Maybe this is mark to market, or I don't know how they estimate this stuff. Let's see. To the auto in good faith and good using unobservable inputs. I don't know what the hell that means. Maybe they just pulled that number out of their ass. But you can see the cat. Yeah, so the Castex is now a total loss, as I expected. ADP has been total loss. Coal is actually a total loss, and this thing is almost paid off. There's 19 million left in terms of cost. So, if they just make anything out of that, anything more than 19 million, they should have ended up with a gain on this Gramercy POC. So this is a CLO, collateralized loan obligation. I think that's what it is. It's probably these some kind of tranched. Oh, it's a company that deals with CLO, and then they're getting subordinate note residual interest. I think this is very close to equity. And so we don't know if this Talos thing is still gonna lose. But it's probably in bankruptcy. they probably talk about it, but this looks like it's probably bankruptcy. If not, redeem. Okay, primary as a result of these investment write-downs, exposure around 13%, 13% to energy, still very dangerous. With their, because the financing that these guys supplied all happened at the peak of the market, so this is very bad. Let's see, remain position in its, you know, part of this reducing. Okay, so Talos production actually paid it all off. Now they have 0 energy exposure. Yeah, this might be a good time to buy. I never, well, maybe I should buy some. I sold out. I should buy some back. They're the where are we? We should be looking at. Yeah, maybe this is a good. It's gonna be a good quarter finally. Jesus. Let's see. Now the only thing that we worry about, at least I worry about, is this OHI thing. It's due. Wow, this is crazy interest rate. 20% effective. Jesus. My gosh, it's almost due. So let's see. Did they discuss this? So that's the last thing that's dangerous. Everything else seems to be just fine. Remains a subject to risk of results from Medicare reimbursement rate reduction. Okay, so let's see. Restore the positive rate of curve. Total investment, yeah. Yeah, this is very dangerous. 20% interest rate. Not many companies can sustain such a cash draw. This is looking pretty bad. So let's think about the best case and the worst case. Let's open up the financial statements. Okay, so we got the balance sheets, and then liability is always true, so always remember that. Whatever happens, your liability is always going to be real. The only problem you have is asset. Asset might not be real. Right, so net asset is 47,771. Okay. All right, let's look at what happened in here. Okay, 47,771. And we need to add in the difference here because they were using the fair value to estimate the book value, the net asset. But in fact, Talos was able to repay the entire thing before this filing took place, as they discussed. So we'll do plus 11534,536 minus 8652. So it's more like $50 million. And then potentially we have to extract this. So worst case, let's say we subtract the entire thing. Is this all? They're still lending more to them. This is insane. Is that? Yeah, I don't know what is really going on here. So let's say worst case, they lose the entire fair value of both the equity and then the subordinated note. 179. You end up with $32.5 million in net asset, and their current market cap is $30 million. So I think there's very limited downside for the company at the moment. I mean, obviously, if you bought down here, you've made yourself a 50% gain, but I wasn't paying any attention ever since I sold it out. I was just looking back to OHIA in terms of yet another mistake I made because essentially laziness. Um, but it looks like even now you may be looking at in a bad situation where they have a total loss on OCI. I think you end up with about 10% discount. Right, so if you about a 10% discount. So in terms of risk and reward, it seems okay. And if you don't consider that, if you actually go by the fair value for OCI, it was something like $50 million, and if you just divide by the market cap, you're looking at like a 60% upside. So yeah, in conclusion, I bought in this company too early at somewhere here, 1.6, I think. Actually, yeah, about 1.6. I bought in at 1.6, thinking I have a huge margin of safety because the book value was something like $100 million or something. Let's see, it was sometime in here, 2017. Yeah, somewhere in here. So I thought I had a huge margin of safety, but it was not real because the asset wasn't reliable, and I did not keep in mind that liabilities are always real, but assets not really. Right, so they had, so their net assets even in 2017 was $142 million. Sorry, that's total. 61 million dollars, and then they kept on doing write downs until by end of 2017, the net asset was something like 50, I think, 47, 70, so 48. But again, now it seems like a good time. I think all the worst is behind OHIA, and there might be a good opportunity. They will release their earnings by what? Their earnings May 14th. Okay, so maybe I can buy some. Yeah, I'll actually go ahead and buy some. If you like this, please subscribe and click like. And I know I promised copper. I'm still doing some. I'm still trying to organize the contents, so that will come. See you next time.